Well, it's not necessarily a bad thing. It really just depends on how you have planned for your retirement. And a little bit of math helps demonstrate that. If you have a $1,000 principal and interest payment in retirement, that's $12,000 a year. The old school retirement thinking was that you could take 4% out of an account and that was a safe amount to take out of a retirement account. And so where that leads us is if you have a $300,000 retirement account and you take 4% a year, that's $12,000 a year. And so it takes a $300,000 asset to effectively support a $1,000 monthly payment. It's important to think about it, and that if you have the perspective or if you have the knowledge that if you have your house paid for, it's like having an additional $300,000 in your 401k or your IRA account, that gives you the motivation. Because let's face it, if you're 15 years from retirement, the last thing you want to do is pay an extra $600-700 on your mortgage when there's so many other things in life going on. But if you recognize that's like having that $300,000 additional savings, it helps you do the right thing when you're a little farther away from retirement than closer to it. Generally, if you can move into retirement with the fewest drains on your monthly income as possible, the better off you are. The theory of the investment and making that money and then paying the debt is arbitrage, which is really a business practice. And I don't know that it's depending on somebody's net worth. I mean, for somebody that has millions of dollars and people that plan all that, great. I don't know how that theory functions for the average American that's going to retire. The arbitrage just doesn't seem to be a big enough number to take the risk. So many people that are in the mortgage business are just purely in the mortgage business to sell mortgages, and so you should have a mortgage and you should have a larger mortgage, and that may or may not be the case. I believe that the best retirement is a retirement that's done debt-free, so there's the fewest amount of drains on your monthly cash flow. If you don't have payments to make, I think you just have a better quality of retirement. That's not the best transaction for the Bank of Bennington necessarily. They're better off making more loans and having loans longer. But we're not a transactional-based bank. I mean, we're a relationship-based bank. And what we do as a matter of practice is at every decision point, we say what's best for the bank, what's best for the consumer, and we work to get a solution that's best for both. And if you have a quality retirement, you're able to go live life, you're going to use other banking services, and it's something that's lost a lot of places, and we just do the right thing. And over time, that pays great dividends because people send friends, family. We're a small bank. We don't have a huge marketing budget, so we function on referrals. Best way to get referrals is just do the right thing by people, and they'll talk about it.